Okay, good evening everybody. Welcome to the next webinar. This particular webinar will be devoted to investment products. As you know, if you look at classified markets, right, there are primarily two types of markets. Primary market is the market in which the securities are traded. For example, if a company goes to the market to issue shares for the first time, in that case, one would say it is a primary market. When the shares or when the units or securities are being created and there is a facility to trade in those securities, then it is part of the secondary market. One needs to understand that a good secondary market cannot operate without a good primary market. Similarly, a good primary market will not be able to function without a good secondary market. Simply because until unless you do not have requisite number of securities and good quality of securities, the healthy functioning of a secondary market is not possible, because simply people will not invest in them, will not trade in them, and there will not be enough liquidity or transparency. Similarly, if you do not find a good value of securities, right? For example, if I am investing in the primary market and the secondary market does not give me the avenue to in terms of trade them, or if I want to liquidate those securities, it doesn't give me a good avenue and doesn't give me a good price for what I have bought, then in that case it doesn't function well either, right? So both primary and secondary markets need to be efficient and well developed, without which you cannot have a healthy financial market. As I've always maintained that in terms of secondary market, we talk about stock exchanges. Okay, you have variety of intermediaries in the stock exchanges. For example, in terms of there will be brokers, there will be investors, there will be custodians, there will be FIIs, there will be other commercial bodies, there will be NRIs, there will be retail investors. So you need a large number of investors, number one. Number two, there should be good quality of securities, which means that all sectors should be developed. There should be a variety in terms of there should be a well diversified number of securities, and there should be a sufficient number of trading interest in those securities. Now, for example, many times what happens is that if you saw in 1992 after the Harshad Mehta debacle, now for a very long time after that Harshad Mehta situation, the interest in the secondary markets or investment in the markets was very low, because the retail investors had burned their hands. Right? Now, until unless you have lots and lots of participants, right? And when I say lots and lots of participants, I mean all kinds of participants. Which means it has to be institutional as well as retail, right? You possibly cannot have a good, efficient market until unless you have all quality of investors operating the market. The market will not be able to function only with institutional investors. It will not function only with retail investors. And even if you are saying institutional investors, right? You should not have a situation where there is only a couple of institutional investors. There should be many types of institutional investors, simply because if you have one or very few institutional investors, they will have the capacity to move the market on their own steam. Right? Because many times, even a year or two earlier, right? Simple fact is that if all the FIIs, right, start operating similarly, which means that they buy and sell at the same time, right? Now what would happen to the share market, right? So the moment they start buying securities, the share market would go up, and in the moment they start selling, the share market will go down, right? But if all FIIs started behaving in a similar manner, right? But an efficient market would be in that respect, wherein you have different class of investors, and each would have a viewpoint of the market, which may not necessarily be similar. Because if everybody starts operating in the same manner, then in that case, the market just would not function, because the moment, let's say, FIIs decide to exit, the market would crash, right? So it is very important for the healthy functioning of the markets that you need to have a well diversified scenario. Secondly, of course, there have been a lot of changes that have happened in the market. For example, DMAT is a very important, it's a very landmark achievement in terms of the stock exchanges, simply because it is easier for people to invest. Otherwise, you had to wait. They used to send their trade transfers, certificates to buy and sell, and then it used to take another 15-20 days for them to get transferred. Now, because it is paperless and there are very few bad deliveries, there's no problem of signatures. Secondly, the rolling settlement, which means it's T+2. which means the moment I execute a trade, within the second or third day, right, the scripts are delivered in my account. So to that extent, the mispricing of the securities is much lesser, right? Plus you have registration of brokers and so many other intermediaries. Everybody is supposed to declare what they have bought and sold as a proper contract note. Everything is upfront, right? There is, nowadays you have screen-based trading, right? It is not through that outcry system whereby you say something on the phone and the broker goes to invest. So what you said and what the broker executes, you don't know. Right now is a situation where any investor sitting in his confines of his home can trade in a terminal, right? And he would be able to, get the best possible price. So therefore, the impact cost, right? When I say impact cost, is basically in terms of the cost of trading between the bid and the ask price, that also has become less. So in terms of the cost of transaction and the cost of brokerage, both have become much lesser, simply because of the fact that the efficiency of the stock markets has improved. Right? Now, this was in terms of primary and secondary. Apart from that, there is a money market and a capital market. Right? Now, when I say capital market, the capital market is basically the market for all the securities that have a maturity of a year or more. Right? And in that case, we have, in a capital market segment, we have two kinds of securities. One is the equity segment, and the second is your debt market. Right? You have the equity market and you have the debt market. There is a situation now that you can even trade in debt, right? In debentures. Of course, normally we used to only talk about trading in terms of equity shares. So today you have a situation where you can trade in debt also, and there is, for example, National Stock Exchange has a wholesale debt market, wherein there is entire listing of the various government securities as well as the corporate securities with their yields, with their ITM, and their majority and the price at which they have, and you can easily buy and sell them from the point of institutional investors. They also have a retail debt market, right, wherein retail investors can also invest in debt securities, but right now the limitation is that they are only suited for government securities. The wholesale debt market, as the name suggests, is basically for institutional buyers. But for the equity market, there is no such limitation, except subject that there should be a market lot. All classes of investors are open to buying and selling securities. Now, money market securities are those which have a maturity of less than 1 year. Now, in money market securities, you typically have something like call money, intercorporate deposits, you have repos, you have treasury bills, you have commercial paper, you have certificate of deposit. These are what you would say are money market securities. In terms of something in the lines of a, let's say, mutual fund, you have something like gilt funds and money market mutual funds. When I say money market mutual funds, basically money market mutual funds are all those kind of mutual funds which invest in securities, again of the money market, which have a maturity of less than 1 year. So money market mutual funds are basically all those mutual funds, and whenever you wish, you can go redeem, right? And you get a rate of return which is almost like a, let's say, a savings bank deposit, but a little bit probably more than that. Gilt funds are those which invest in government securities, right? Government securities of various denominations and maturities. But when you say gilt funds, it means investing in government securities. So this per se constitutes the universe of money market securities, right? Now, before I actually get on to the various products of money market, right, I'd like to discuss the constituents of the capital market. As I said, the capital market chiefly consists of equity and debt. If I want to go further, then probably you will have something like preference shares also, right? Now, when you say equity shares, right? Now, what is an equity share? Right? An equity share is something that represents ownership of a company, right? Now, what is the origin of an equity share? Okay. Now, earlier, when till the joint stock company came, right, everybody knew each other, right? So, you have a sole proprietorship, so everybody wanted some money. They would basically ask the person that, please loan me money, right? The person would get the money, and that is how the business used to operate. It would be basically in a village kind of an economy. But the moment you had this joint stock company and you had the industrial revolution, which means that you needed access to lots and lots of money, right? And obviously, when you are having lots and lots of money, now there may be some people who may be willing to invest a little bit more, but there may be some people who may be willing to invest only a little amount of money. Secondly, they wanted to be having some security of investment. Third, they also wanted to be assured that whenever they wish to exit, right, they may be given the option to exit. Now, for example, if I invest in debt, right? Now, if I invest in debt, right, I have to wait till there is a particular maturity. Only then can I exit from debt, right? In most cases, there is an equity, as we see now, that whenever I choose to exit, I simply have to go to the stock exchange or to the secondary market and say that I would like to sell these shares, and I would get an exit option. So that is how the concept of an equity share came in. That means that what the company did was that in order to attract capital from lots and lots of investors, it issued units of its capital to a wide variety of investors. Now the advantage of this is that as far as the loss of the person concerned who is investing in this particular company would be only limited to the extent of the investment limit. Right? For example, if I am in a sole proprietorship or a partnership, and let's say the business went bankrupt, in that case, my loss would not be just limited to the amount of capital that I invested in it, but could be also to my house and my property in case the losses were much more than the capital invested in it. Right? Now, if this is the situation where you have unlimited liability, nobody would like to invest. Right? So that is why you have a situation in an equity share where there is limited liability. I am investing in a company and my liability is only limited to the amount of investment that I have made. So the maximum loss that I can incur is only to the extent of what I have invested. Now this itself is a very big attraction for people to invest in equity shares. Now the moment I created equity shares, right, there is some terminology, something that describes the various aspects related to equity share. Right? Now the first thing that you see in a balance sheet is something called authorized capital. Right? Authorized capital simply means that the capital that the company is authorized to issue, which means that when it files with the registrar of companies, it specifies that this is the authorized capital, this is the maximum amount of capital that I can issue. Of course, with that, the company can always make changes with the necessary changes in terms of they have to take the necessary regulatory approvals, but they can change the authorized capital. But at a particular point of time, as stated in its memorandum, right, which is filed with the registrar of companies, they have to state that this is the maximum authorized capital that a company is authorized to issue. Then you have issued capital. Now, issued capital is the capital that the company has actually issued, right, in terms of the number of shares, right, and in terms of whatever power. That this is the capital that the company has issued. Whereas paid up or subscribed capital is the capital that the company has actually received. Right? Now there may be many times where there may be a difference between the issued capital and the subscribed capital. Now the reason can arise for two reasons. Right? Now one, of course, what happens is that if a company gets 90% of its issued capital, it gets to retain the money. Only if the issue is subscribed to the extent of less than 90%, does the issue fail. Right? So as long as it issues, it receives 90% of the subscription, the issue goes through. Right? Right? So that is one reason where they can have a change between the issued capital and the paid up capital. Secondly, what happens is, which of course in today's situation it does not happen. Many times companies do not issue capital at one go. Right? For example, when they issue shares, they will have the first amount, then the first call, and then the second call, and the third call. So what happens sometimes is that the investor may pay the first installment, but the money may be on the first call or the second call may not be paid. In that case, those shares are forfeited and the investor does not get back the money. Right? So in that case, again, there is a difference between the issued capital and the subscribed capital. Right? Now, in the subscribed capital or issued capital, there will be a term called par value. Right? Now, the par value is simply the unit on which, at the rate at which dividends are declared. Right? Now, many times we say that Hindustan Lever is, let's say, declaring 100% dividends. Right? Now the market price of Hindustan Lever I think is around 190 at the moment. Right? Now it doesn't mean that per share Hindustan Lever is going to give 190 rupees. Right? What it means is that when it says 100%, it means that on the par value, which may be rupees 10, right, it is going to have 10 rupees as dividend. It means that effectively on a share which costs 190 rupees, I am getting only 10 rupees as dividend. Right? So the yield on the market price is very low, but in terms of stating as a percentage, right, it is always stated as a percentage of the par value. The par value can be as low as rupees 1, but not below. Right? Earlier, we used to have par values of not less than rupees 10, but today we have a situation where the par value can be as low as rupees 1. Right? Again, on the balance sheet, right, you will have in terms of paid up capital, right, there will be reserves and surplus. Right? Now, in reserves and surplus, right, you will have, as I said, in terms of, right, when you have owner's capital, right, there is a section which is called owner's capital, which is also called the net worth of the company. Right? Now, it is composed of two things. One is the paid up capital, and the other is the reserves and surplus. Right? The paid up capital, as I have said, is simply the par value of the share multiplied by the number of shares. Right? Now, please always remember that the par value of a share can keep changing. Right? Maybe in previous times, right, the company may have issued 1,000 shares and let's say rupees 10 par value. Right? But in another period, right, it issues again 10,000 shares at rupees 1 par value. So the paid up capital will be 20,000, but the company will have to give a description saying that 1,000 shares at rupees 10 par value and 10,000 shares at rupees 1 par value. Right? Now, in terms of the reserves and surplus, there are two parts to it. Right? Now, from the point of view of description, though it will not be stated as capital reserves and revenue reserves, but one needs to understand the difference between revenue reserves and capital reserves. Now, revenue reserves are those reserves which are basically coming from the fact that whatever net profit that you have, now there is a certain percentage that you will retain and a certain percentage that you give out as dividend. The portion that you retain from the business, right, which you earn as income and retain in the business, right, is part of your revenue reserves. Whereas the capital reserves are those reserves which come from either share premium, right, or you may get a capital subsidy or an investment allowance, right, or there may be something like a revaluation. Right. In all these cases, there will be something like capital reserves. Specifically, it is not coming from the earning. Revenue reserves are those which are coming from the earning, whereas capital reserves are those which are coming from other reasons. Right. And the most prominent, of course, would be share premium. Right. So, for example, if you say I issue, let's say, a share of rupees 100, right? Let's say 100 shares at rupees 100, right? Rupees 100 at 100 shares, right? Now, let's assume that rupees 10 is the par value, right? So, in that case, the paid up capital will be 100 into 10, 1000, whereas the reserves and surplus will be 90 into, right? That is how the division is going to. Now, the total of paid up capital, reserves and surplus is called a net worth. It is also called the book value of the company. Right? If I divide the book value of the company by the number of shares, I will get the book value per share. If I divide the number of shares, if I divide the net worth of the company by the number of shares, I will simply get the book value of the share, book value per share. Right? There is something statistics called market value. Now, the market price that you have in the share market is not necessarily the book value of the share. The market value of the share at which you are trading is not necessarily the book value of the share. Why? The book value is a historical concept. Right? You may have issued capital at a particular point of time at a particular price. Right? But as the share, right, or as the company continues to make profit, right, it is always valued at a multiple to its value, right? Because we are looking at a company basically at what it is capable of producing. So it is a very forward-looking approach. So when it is a forward-looking approach, basically I am looking at now what the company's earnings are going to be in the future, and I try to discount them, right? So therefore the market price will have some relation to the book value, but it is not necessarily equal to the book value, right? And that is why when you say price earning multiple, right, there is something like a PE multiple. There is also something, a ratio called a market value to book value, which means basically how popular is the share with respect to its book value, and how many times, what is the multiple of market value to the book value. The more the market value to the book value, the more we say that the share is attractive, right? In terms of the investor perception towards the company is in terms of how it values the company, right? Because the market price obviously is much higher than the book value. So we say that it's an attractive script for the investors to buy. Okay? Now, then you also have something like a PE ratio. Right? Now, PE ratio is nothing but the market price of the share divided by the earning per share. Right? The market price of the share divided by the earning per share. The earning per share obviously is simply the net profit of the share divided by the number of shares. Right? The net profit of the company divided by the number of shares, one would get the earning per share. If I divide the market price per share of the share by the earning per share, then I will get something like a P multiple. Right? Now, one is a P multiple in terms of past. Right? You can have a past P multiple. One can have a forward-looking price earning multiple, wherein I can look at the market price at the moment, right, and value it in terms of what is the expected earnings. Right? I can look at it in terms of the expected earnings. Now, the question that one can raise is that why is the price earning multiple such an attractive proposition? See, what happens is when you come across a lot of newspaper reports, you will find that it is trading at a very attractive P multiple, or it says the valuations are overstretched, the P multiple is very high, right? Or not in general, you say, right, 10 to 15, EPS is, they say, is a reasonable estimate, right? The moment they say that the market price is, let's say, 20 or 25 times the earning per share, which means they say that the valuations are overstretched. Which means that, see, if you are saying that, when I am saying in terms of earnings, right, and the market price is 15 times the earnings, right? Now, when I value the company, right, and which I'll just come to it in some time, I basically discount the earnings, the future earnings, to the present value. Right? Now, if I am discounting the earnings by a certain period of time, now either I am expecting that the earnings will really grow at a very high rate. Right? See, unless and until, there are two things, when you value a company. Right? See, I have already explained to you that the valuation of a company is a subject of two things. One is regular income, and one is basically the capital appreciation, etc. Right? Now, for the time being, let me assume that I hold the share to infinity. Right? I don't want to sell it. Right? And we all understand that shares is a permanent source of capital. It means, except when the company basically buys them back, otherwise they are always in existence. Right? I may sell them, but he may buy them. He may sell them, but you may buy them. But as far as form of a capital, right, as a form of a unit of ownership, it is there, right? Which is not so in case of debt capital, because debt capital has a fixed period, and whereas after which it is redeemed. Whereas equity capital is permanent, right? Unless of course the company liquidates, goes out of operation, that's a different issue, right? Or as I said, that the company decides to delist, buy all the shares back, right? And in that case, the shares are extinguished. But otherwise, we always treat it as permanent form of capital. Now, if I am taking a capital as permanent form, right? Now, what I am concerned is with basically what the regular income that I want to get, right? Now, the regular income that I want to get is basically the earnings, right? It is basically the earnings. Now, which means, let's assume that model, let's say I am assuming that EPS, right? For the time being, let us consider this, and that is why I am explaining that the concept of price earning multiple. But if it is overstretched, what actually means. That means in the first period EPS 1, EPS 2, EPS 3, EPS 4 and so on, infinity. Right? This is how you would value it. Right? Now let us in the first period divide by 1 plus k, second 1 plus k. This is the third period, so I will discount it by 1 plus k to the power 3, 1 plus k to the power 4, right? And this obviously, right, I can, if it's infinity, right, then I can simply divide it by k, right? And to bring it down to this level, now if I am discounting it, right, there will be some market price that should come. Obviously, there should be some market price. Now, here what I am saying, that the market price can be high with relation to my EPS in only two situations. Either the EPS is growing at a very fast rate, or the discount rate is very low. In only those situations is my market price going to be very high with relation to my EPS. There is no other third situation. Either the growth rate is very high, right, or the required rate of return is very low. Right? These are the only two situations that I can have. Now, even if I am to assume, let's say that the growth rate is very high, right, that the EPS is growing at a very fast rate of growth. In that case, right, everybody knows that if the returns are high, right, if the growth rate is high, I am expecting high returns, then my required rate of return will also be high, no? Right? See, the more the return, the more the risk. Right? So the required rate of return will obviously be higher. So there is no question of this being low. Right? So even if I, in that case, to feel that maybe 15 to 20 times is acceptable level, that okay, fine, I can expect that this might be this multiple. But beyond that, right, it feels that I just cannot achieve it. Right? Even if I pay that higher price, to feel that I will be able to gain in terms of high EPS growth will just not happen, right? So in fact, every time the market valuation, for example, whatever the cumulative earnings of the entire companies in the universe on the stock exchange, right? And right, for example, you have a Sensex P multiple, you have a stock market P multiple. So say the moment it goes about 20 times, then you feel that there is a technical correction that is required, and the market may obviously fall, right? So therein lies the importance of a P multiple, right? Now, there are other terms that are related to the stock market, but in terms of making a decision whether to buy it or not buy it, for example, if you're looking at fund managers, right, you say very high P multiple, the fund managers say no, it is overstretched, it is too high a price to pay for it, it is overvalued, right? You can say it is obviously, if you have a high P multiple, it is attractive to some, but some people will say that you just invest in it, right? You may not get the returns, you just pay too high a price for a particular product, right? For example, if you go to the market, and everybody is like this advertising a product at this, right? So you end up going to the market, everybody is saying that it's a wonderful product. You go and invest in it, right? And then you bring it home, right? You realize that what you have paid for, it may not have the features, it does not have the functionality that you expected it to, right? So in that case, you feel that you have overpaid for a product which obviously did not have the advantages or uses that it should have, right? Now, in terms of other terms that are related to, in terms of equities, one is dividend yield, right? Now, dividend yield is nothing but whatever is the dividend per share divided by the market price, right? Similarly, you will have something like called a earnings yield, which is simply the earnings per share divided by the market price per share. Now, there is something called a dividend payout ratio. Now, dividend payout ratio is nothing that total amount of dividends or total amount of dividends paid divided by the net profit, or you can say dividend per share divided by the EPS. Right? A dividend payout ratio is nothing but a dividend per share divided by the earning per share. If you subtract the dividend payout ratio from 1, you will get the retention ratio, right? Which is the proportion of investment that is retained in the business, right? Or you can say whatever is the retained earnings per share divided by the earnings per share. that is the retention ratio, right? Now these are some basic terms which, right, you need to understand in terms of equity, right? I'll repeat: the market price per share, right? The market price per share is basically whatever is the market price that is prevailing by trading the security, and it reflects the prospects of the company and what the price that the investor is willing to pay for the, receiving a stream of benefits in the future. Obviously, in terms of market price, it is determined by the interactions of demand and supply of those people who are willing to invest in it. There will be a demand for that particular share, there will be a supply for it. There will be some people who want to buy the share, there may be some people who want to sell the share. By the cumulative interaction of the buyers and sellers, the market price of the share is determined. The book value of the share is simply the reserves and surplus plus the paid up capital divided by the number of shares. That will be the book value per share. Yes. The reserves and surplus plus the paid up capital divided by the number of shares, you will get the book value of the share. Right? The P multiple is the market price divided by the earning per share. Right? You have, right, in terms of yield, right, you have the EPS divided by the earnings yield divided by the market share, you will get the earnings yield. If you divide the dividends per share divided by the market price per share, you will get the dividend yield. There is a term that you have in terms of market capitalization, right, which means that simply whatever is the number of shares multiplied by the market price of the share, you will get the market capitalization. There is another term which you often come across, which is called a free float. Right? Now, for example, whatever those Sensex or whatever those indices are computed, right? One is a price weighted index and one is a value weighted index. A price weighted index is a number of companies in it. You will get in terms of you will simply get a price weighted index. Whereas in a market value index, right, you will multiply the price of the share multiplied by the number of shares. You will add up all of them, right, and find a weighted average, right. You will get a value weighted share, a value weighted index, right. Now most of the indices are basically value weighted. A free float basically comes from the practice that, when you multiply by the number of shares, what you actually look at is the number of shares that are with the public at large. We subtract the shareholding that is there with the promoters or strategic investors. So all the shares which are floating and which are available for trading, right? So only those number of shares are used in terms of market capitalization for arriving at value of indices, right?